Today, we're going to discuss 8 rules from Warren Buffett that can transform your life. Warren Buffett is renowned as the greatest investor of all time. If your grandfather had invested $100 in his investment company when it started, it would be worth over $3 million today. So why didn't Granny do it? But how did Buffett achieve this success? Let's delve into his 8 rules in 10 minutes. Warren's first rule is that intelligence and integrity are the foundation. Warren Buffett states that when hiring, he looks for 3 qualities: intelligence, initiative or energy, and integrity. He stresses that if a candidate lacks integrity, the other qualities, intelligence and energy, can be harmful. Without integrity, Buffett would prefer the person to be lazy and dumb rather than smart and energetic. He believes that intelligence and energy, when paired with integrity, create a powerful combination that can drive a company forward. However, without integrity, intelligence and energy can lead to unethical behavior and decisions that can harm the company in the long run. Buffett's emphasis on integrity highlights the importance of ethical behavior and trustworthiness in achieving sustainable success. This rule not only applies to hiring, but also to personal conduct and business practices, underscoring the vital role of integrity in all aspects of life. The second rule is to pay attention to the facts, not emotions. Warren Buffett observed that investors often exhibit typical human behaviors. They tend to become highly enthusiastic during bullish markets, reflecting on past successes by reasoning, "I made money last year, so I'll make even more this year. Maybe this time I'll use borrowed money." Or, influenced by a neighbor's success story, they may impulsively decide to enter the market. This tendency to look backward persists. When investors see recent profits, they eagerly increase their investments, driving prices higher. Conversely, if they observe a lack of recent profits, they dismiss the opportunity, regardless of the underlying business fundamentals. This recurring cycle, though surprising, creates significant opportunities for astute investors. You can capitalize on market misjudgments and fluctuations. The third rule is to buy wonderful businesses, not secret bots. Buffett learned from Ben Graham to approach investments quantitatively, seeking out undervalued opportunities. This lesson, imparted in 1949, deeply influenced him to search for what he termed cigarette butt stocks. This strategy compared investing to finding discarded cigarettes on the street, picking up one with just a puff left, getting that last bit for free, and then discarding it. While this approach can yield profits, Buffett eventually realized its limitations in generating substantial wealth. Instead, he now prefers investing in outstanding businesses at reasonable prices rather than settling for mediocre businesses at bargain prices. Rule number 4 is to invest in stocks that you understand. Buffett adheres to a traditional belief that one should only expect to profit from investments they truly understand. For him, understanding goes beyond knowing the product. It involves foreseeing the economic landscape of a business a decade or two ahead. He has a clear grasp, for instance, of how regularly chewing gum will fare in the future. The advent of the internet won't alter people's gum chewing habits or preferences. With ownership in major gum brands like Doublemint and Juicy Fruit, Buffett anticipates this brand will endure. While he can't predict exact figures for Wrigley, his assessments typically align well. This evaluation process falls squarely within his circle of competence, comprehending their business operations, economic dynamics, and competitive landscape. Rule number 5 is to take the opportunity. Buffett emphasizes that the most significant mistakes he has made stem from not acting on opportunities within his circle of competence, rather than from active missteps. These omissions, where he knew enough to make informed decisions but hesitated, have proven costly for Berkshire, potentially amounting to billions in missed gains. For instance, he regrets passing on the chance to acquire Fannie Mae at a bargain price nearly 2 decades ago, a decision that doesn't reflect in traditional financial reports, but carries substantial consequences. He underscores the importance of seizing valuable opportunities, regardless of their scale, likening each financial decision to a precious punch on a limited card. Buffett stresses that these opportunities are rare and pivotal for building wealth over time. Despite lucrative offers, he remains unwavering in his stance that Berkshire's wholly owned businesses are not for sale, emphasizing his commitment to long-term investment and enduring value over short-term gains. Rule number 6 is not to sell because of price fluctuations. Buffett firmly asserts that Berkshire Hathaway will not sell assets like See's Candies or Buffalo News, even if offered 3 times their current market price. He believes this approach is essential for preserving his legacy, ensuring financial stability for the Berkshire Foundation, and maintaining strong relationships with stakeholders who view Berkshire as a permanent institution. To Buffett, these assets represent more than financial assets. They embody commitments and values that transcend immediate financial gains. He compares selling these cherished assets solely for a large sum of money to selling one of his own children, a decision he vehemently opposes. Buffett's commitment to his partners and shareholders involves avoiding actions that could disappoint them, reinforcing Berkshire's strategy of long-term ownership unless there are significant changes in management or economic conditions that warrant it. Buffett also defines intrinsic value as the present value of all future cash flows that a business is expected to generate, discounted at an appropriate rate. This metric, based on fundamental analysis rather than market speculation, serves as a true measure of a business's worth in his investment philosophy. Rule number 7 is to buy stocks below what they're worth. Warren Buffett emphasized that the core objective of investing is to deploy capital now with the expectation of receiving more money later. This foundational principle underscores the essence of his investment strategy. When contrasting stocks with bonds, the distinction is clear. Bonds specify upfront what investors will receive in terms of interest and principal repayment, with their value subject to fluctuations in interest rates. In contrast, stocks lack such explicit clarity. Analysts must interpret future cash flows based on the ownership represented by a stock certificate, essentially transforming it into a conceptual bond that forecasts future returns. Whether investing in machinery for Shaw's carpet production or acquiring a major entity like Coca-Cola, the central question remains: would one commit substantial capital today in anticipation of long-term returns over decades? Over time, the relevance of discount rates diminishes, focusing instead on the certainty and scale of future cash flows. Buffett calculates the intrinsic value of a business as if purchasing the entire enterprise, forecasting its future earnings and reinvestment potential. Despite Berkshire Hathaway's policy of not paying dividends, its capability to distribute cash increases as the underlying businesses rise in value. Currently valued at around $105 billion, Berkshire assesses whether it can sufficiently distribute cash returns to justify current investments, especially in light of prevailing interest rates. Determining a business's intrinsic value remains critical for Buffett before making investment decisions, a rigorous process aimed at ensuring prudent financial management. And finally, rule number 8. If you don't find a way to make money while you sleep, you will work until you die. This is undeniably true. Without enough passive income or sufficient savings to support yourself, retirement will remain out of reach. But you can reduce this risk to nearly zero by watching our latest video, subscribing to our channel, and leaving a like. Let's achieve some financial success together. Leave your comments below, and there will be much more useful content for you.